Hello everyone, I'm Yusuf Topal. Today we're talking about something really important, rising interest rates. When interest rates go up, does the stock market go down, or is this a chance to get rich? In 2022, the US Federal Reserve raised interest rates and the Nasdaq dropped 30%. But how did some investors make money during that same time? Today I'll explain what rising interest rates mean for investors, which industries win and lose, and the best investment strategies. If you're ready, let's get started. Now, what's the first thing that comes to mind when you hear interest rate hike? Rising interest rates usually make people rethink their finances. You're probably thinking about your credit card debt, right? When interest rates go up, credit card debt and other loans get more expensive. You're right, interest rate hikes affect everyone's wallet. This can impact everything from our daily spending to our savings. But it also shakes up the whole economy, especially the investment world. Investors are very sensitive to interest rate changes. Central banks raise interest rates to fight high inflation. This is a measure taken to balance the economy. By doing this, they aim to get people to spend less and cool down the economy. When spending decreases, demand falls, and inflation can be controlled. However, this leads to a number of effects, such as increased borrowing costs for companies, consumers spending less, and company revenues falling. Companies have to rethink their strategies to deal with rising costs. A stronger dollar causes money to flow out of emerging markets. This can negatively affect economic growth in these countries. This can also lead to fluctuations in the stock market. Investors become more cautious during times of uncertainty, and this causes volatility in the markets. Historically, we see that the interest rate hikes in 2008 and 2022 had serious effects on the stock market. During these periods, investors experienced big losses. During the 2008 global financial crisis, central banks tried to stimulate the economy by lowering interest rates. However, this did not have the desired effect, and there was a major crash in the markets. However, this led to a big drop in the stock market. Investors started selling their assets in a panic. Similarly, in 2022, the US Federal Reserve's aggressive interest rate hikes caused the Nasdaq to fall by more than 30%. This led to major losses in technology stocks. So, does this mean disaster for investors? Absolutely not. Every crisis also presents new opportunities. Remember, every crisis also creates new opportunities. The important thing is to be able to see these opportunities and take the right steps. The important thing is to determine the right strategies and be able to read the market well. Investors should act more carefully and consciously during this period. Interest rate hikes don't affect every sector in the same way. Economic dynamics and the structural characteristics of sectors cause these effects to vary. Some sectors are negatively affected by interest rate hikes and can be seriously damaged by this situation. Especially sectors with high debt burdens may have difficulty controlling their costs with rising interest rates. However, some sectors can also benefit from this situation. Interest rate increases can create new opportunities for certain sectors and increase their profitability. For example, the banking and finance sector is generally positively affected by interest rate hikes. Banks can lend at higher interest rates and make more profit. Because banks can lend at higher interest rates and make more profit, this increases the profitability of banks and strengthens their financial performance. The consumer staples (FMCG) sector is also relatively less affected by interest rate hikes. People continue to buy basic necessities like food and beverages, even during times of economic uncertainty. Because people continue to buy basic necessities like food and drink, even during times of economic uncertainty. Therefore, the FMCG sector is more resilient to economic fluctuations. Commodity and energy sectors also generally perform well during periods of high inflation. Assets such as oil, gold, and silver are seen as hedges against inflation. Because assets like oil, gold, and silver are seen as hedges against inflation. These assets are considered safe havens for investors and demand increases. On the other hand, technology stocks, growth companies, and the real estate sector can be negatively affected by interest rate hikes. These sectors generally grow by using high amounts of debt. Technology companies generally use high amounts of debt to grow. When interest rates rise, the borrowing costs of these companies also increase and their profitability may decrease. When interest rates increase, the borrowing costs of these companies also increase and their profitability may decline. This can slow down the growth rate of technology companies and shake investor confidence. The real estate sector is negatively affected by the increase in mortgage interest rates. When mortgage rates rise, buying a house becomes more expensive and housing demand falls. Because when mortgage rates rise, buying a house becomes more expensive and housing demand falls. This can lead to stagnation in the real estate market and cause prices to fall. Chapter 3. Now let's get to the most important topic. How should we invest during periods of rising interest rates? Acting with the right strategies during this period can help you protect and even increase the value of your investment portfolio. Here are a few golden strategies for you. First, focus on value investing. Value investing involves investing in companies with low market value but strong fundamentals. As legendary investors like Warren Buffett often emphasize, finding cheap but solid companies and holding them for the long term is a strategy that remains valid even during periods of rising interest rates. This strategy allows you to be more resistant to market fluctuations. Investing in companies with low debt, regular dividends, and a strong competitive advantage can help protect your portfolio from the negative effects of interest rate hikes. These types of companies can perform steadily even during times of economic uncertainty. Second, you might consider turning to dividend stocks. Dividend stocks provide investors with returns not only through stock price appreciation, but also through regular profit-sharing payments. Dividend stocks are shares of companies that regularly distribute profit shares. These stocks provide investors with a regular income stream and may be less sensitive to market fluctuations. Even in a falling stock market environment, dividend stocks can provide you with a regular passive income. This is a big advantage, especially for investors in retirement or those who need additional income. Third, never neglect to diversify your portfolio. Diversification is one of the most effective ways to reduce your investment risk. Instead of just investing in stocks, you can spread your risk by investing in different asset classes such as bonds, gold, and dollars. This can improve the overall performance of your portfolio and minimize potential losses. Remember, no single investment tool is perfect. Each asset class has its own risks and returns. By investing in different asset classes, you can make your portfolio more resilient to market fluctuations. This allows you to achieve a more stable return in the long run. Finally, avoid panic selling. Panicking and selling your assets during market declines can lead to big losses in the long run. The stock market has always had its ups and downs historically. Short-term fluctuations should not change long-term investment strategies. However, in the long run, it has always followed an upward trend. As a patient and disciplined investor, you can benefit from these fluctuations and profit in the long run. Chapter 4. There are some common mistakes investors make during uncertain times, like interest rate hikes. By avoiding these mistakes, you too can make more informed investment decisions. The first mistake is short-term speculation. Markets can be quite volatile during periods of rising interest rates. Trading daily or even hourly can lead to losses in the long run, even if you have a high risk tolerance. Remember, investing is a marathon, not a sprint. The second mistake is investing in a single sector. As we mentioned earlier, interest rate hikes affect some sectors positively and others negatively. If you invest all your money in a single sector, your portfolio is at great risk. Diversification is the golden rule of investing. The third and perhaps biggest mistake is succumbing to psychology. Fear and panic are the investor's biggest enemies. Panicking and selling all your stocks when markets fall, or conversely, making hasty decisions and risky investments during rallies, can take you away from your goals in the long run. You must learn to stay calm, think long-term, and stick to your strategy. Interest rate hikes are an important factor in the investment world. But with the right strategies, you can successfully overcome this period and even turn it into an opportunity. So, do you think interest rate hikes are a danger or an opportunity for investors? Write in the comments. Don't forget to subscribe to the channel for more investment strategies and turn on notifications. In the next video, I'll share the top 5 investment opportunities against interest rate hikes. See you in the next video. Goodbye.